Hey there, Canadian Wealth Secret Seekers. I'm here to answer a question that I get quite a bit, and I want to give you an example. So it's going to be a little bit of a case study, but I'm contacted quite a bit in regards to reviewing older participating whole life policies and helping clients to understand whether they're worth keeping or not. And of course, everyone's situation is different, so there's no one, blanket answer that you can give here, but we can definitely use some of these cases to help you assess whether your old policy makes sense to continue funding, whether you want to gear back or fund less, or maybe offset, or in some cases even cancel and put into other assets. Maybe it's into a better designed policy. Who knows? But let's take a look at what we have here. So I was reached out. I've blanked out all identifying information here, but we get a lot of discovery calls where people ask us a pretty straightforward answer. So this particular client, rather than meeting them, I actually said, you know what, let's dig in a little bit ahead of the meeting to try to figure it out. Because their big question here is, they have a measly whole life policy. Their husband had it since 1980, and they want to learn if it's possible to use it to their advantage or if they should cash it out. So I had asked for some more information. And they were helpful in sending it along. I also asked them for a little bit of context. So the participant or the policy is on the husband's life, which he is 61. And this particular client is about 52. And you can see here the income. You can see some assets here. They own a house, no mortgage. So in my mind, I'm picturing that, maybe like leverage might not necessarily be something that they're interested in engaging in. Not to say that it's not, we can't blanket anything here. But they have some, decent assets, but not a huge amount. They probably have some room in their buckets and specifically in their RSPs. This here, I'm not sure yet if it's $110 or $110,000. If it is, I would recommend that they flip that over to the RSP. But then they've got, small pensions, a little bit of CPP, a little bit more CPP. So with this statement, they had also shared the actual policy. So what I'm going to do here is overview this policy with you. So again, it's been in force since 1980. And what I noticed right away in this particular policy is that there's a whole life portion that has a face value or a death benefit of about $22,000. And basically, the monthly premium is very low for that amount, right? So, we could do some math on that. If we think 1980, what are we looking at? 44 years or so of 2194. So, hey, if you're putting in 2194, 12 months times, 44 years, you've put in about this much money. There is some cheap accidental death on there, so not a big deal either way. Hey, an extra 22,000. Waiver of premium put on there. We'd have to see which waiver of premium, like what that means in this particular case. It might mean that, hey, if they were disabled or something, that they wouldn't have to actually continue funding. But this is the part that catches my eye right here, is that there is a 10-year renewable term rider, which means every 10 years, this $100,000 rented insurance is going to continue going up in cost. Right now, it's $100 per month, or about $1,200 per year to have this 10-year renewable term rider. So the big question is, do they need that insurance just in case he was to pass away, say, before retiring in a few years? If the answer is yes, then maybe it's worth keeping. If the answer is no, I might recommend just getting rid of this term rider, because at this point they have been doing some paid up additional insurance, which is helpful. That means that they're getting additional cash value is being collected or created here. And it says that that's the benefit amount. The one thing I don't know is how much additional paid up insurance have they contributed themselves, or is that all from the dividend? Either way, based on that, we can see where they are. We see here that there's a total cash value of about $22,000. So assuming that this policy, assuming that they just paid this amount for the actual participating whole life portion, then, this cash value they've generated has actually been pretty awesome. Now, did they pay any additional premium along the way? That part I don't know here. However, my wonder is that right now they have this cash value. Now, if they want to leverage the cash value and utilize it, they're more than welcome to do that. They can ask the insurance company. That might make sense. However, to continue paying, a small amount, say 20, 25 bucks a month to continue funding this policy could make sense. However, remembering the death benefit associated with that portion of the policy is so small, it's only $22,000. I don't like that they're putting this much money into this $100,000 death benefit. So if they feel that they don't need this for an emergency, meaning it's not there to protect for income if, let's say, the husband were to pass, and that $100,000, if that's not necessary, if he were to pass today or even over the next 5 years, I would say taking that 100 and putting it towards something else, maybe the RSP, if there's room in the tax-free savings, that might make more sense. Or you might take that $100, and if you really like the idea of permanent whole life policies, you might consider opening a different participating whole life policy, because he's 60 now. When every 10 years, that amount, that term rider is going to get more and more expensive, and eventually they're going to cancel that portion. So they should be able to cancel just this one line item here, and they can continue making these payments if they'd like. They could continue doing the waiver of premium. You might be able to ask, hey, do we need to do that or not? Maybe we discontinue this and just focus on continuing this small whole life amount. Or maybe they're taking the entire policy, the entire cash value, and putting it into that RRSP that they still have some room. I'm anticipating that they still have some room inside that RRSP. So that would be something that I might consider recommending for them to do. So on the surface, this policy is probably not designed in the best way that we can now design policies. Could it have been designed better back then? Quite possibly. I don't know. I don't know this particular company very well. However, what I can tell you is that based on what they're doing here, I don't like the actual term insurance portion. And you'll see here, they even got a note in July saying that in accordance with the terms of your contract, the 10-year renewable term rider monthly premium is going to change to $131 per month. So it was over here a total of 103. So it's rising by $30 per month. Might not seem like a lot, but that's $360 extra that they're putting towards it at the end of a year. That's going to be a lot of money that they could have been maybe putting towards their RRSP or some other type of investment, rather than keeping this term rider that they will not get any of this money back from. So that would be my sort of suggestion for this particular policy. If you have one you would like us to review, head on over to CanadianWealthSecrets.com/discovery. We'll check it out for you. We'll analyze it, and we'll look at your situation to really decide where should you be putting this capital. In a lot of cases, there's people that have permanent insurance, but they don't necessarily have a need for it. Having a death benefit of $22,000 or even $50,000, it's not really a significant amount. If I can generate a greater return in some other type of asset or vehicle, that might be the best way to go. And I'm really focusing on permanent life insurance for those people who are going to have significant amount of, say, estate taxes, or if they intentionally want to be leveraging the policy so that they can optimize their investments, such as investing in real estate or private lending or doing some sort of alternative investment strategy, or if they own a business and they're looking for ways to help them get actively earned corporate income into their personal pocket over time without paying all of the personal taxes. So once again, my name's Kyle Pierce from Canadian Wealth Secrets. Head to CanadianWealthSecrets.com/discovery to book your call if you have a situation like this, or if you're a business owner and you're looking for strategies to minimize taxes and maximize your wealth. please head on over to the website, and we have the podcast Canadian Wealth Secrets on all platforms. Give it a subscribe, a rating, and a review. And I hope to be doing some more of these for you in the future. Thanks, and chat soon.